Street firms took $274 billion in taxpayer money. When they weren't doing well, they paid $18 billion in bonuses. But they couldn't pay the taxpayers $3.2 billion of the amount paid out, the excessive amount paid out in cash when the taxpayers are being hit.
Most urgent task upon taking office was to shore up the same banks that helped cause this crisis. It was not easy to do. And if there's one thing that has unified Democrats and Republicans and everybody in between, it's that we all hated the bank bailout. I hated it.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers as we discuss how non-banks are potentially creating a housing market collapse. And I have our community expert, Melody Wright, here with us today to help us figure out what's going on underneath the hood as it pertains to homeowners, the delinquencies, what's going on with the banks, things of that nature. And what we're going to do today, guys, is we're not going to use Black Knight. We're not going to use any of those people directly. We're actually going to use all of Melody Wright's data, all of her experience. And I'll tell you guys why we're going to trust what she's saying here in a second. But before I do, let me just quickly plug you, Melody. If you guys want some more of her brilliance, oh my gosh, the Substack was so good, by the way. Go to her Substack, M3, subscribe or don't subscribe. There's some free versions as well, but you would be supporting an independent journalist. Melody, I love your writing. I love supporting you. She's always like, Travis, I'll give you the free account. Like, no. Friends help other friends when we can afford to, right? And then also, guys, here's her YouTube channel, Melody Wright. Great channel. Love the Forgotten American series. Want to see more of that. I absolutely love your cause. And don't forget, guys, she's also a member of the Doomers News Network. Melody Wright, how are you?
I'm doing well, Travis. We've been a little busy, haven't we?
Yes, we have been a little busy. We have been a little busy trying to save the world. It feels like that. You know, trying to save the world, trying to spread awareness, trying to figure out what's going on. And you know what I'm asking myself, Melody, is how deep do the lies go?
Yeah, I just want to say, Travis, I think it's so great. The fact that Mitch's story is getting out there on the appraisal fraud. And I just want to congratulate you again. It was because of you and your community that you guys have been able to bring this forth, and it's getting traction all over. So I'm just really proud.
It's something that impacts every single American, and is literally something that is in sight that not even a lot of us, but just a few amount of us need to step up, and we will bankrupt the CADs, which affects municipalities. Again, you know, we've been all watching the wrong things, and that's part of what today's video is. And Melody, you know, I want to tell the viewers real quick. So when Melody's answering these questions and we're presenting you the data, as the viewer, here's what I want you to ask yourself, and here's what I'm going to lean towards when I'm talking to Melody. Was the price decline, the home price decline during the GFC, more a result of non-banks and banks needing bailout and speculation versus the foreclosure crisis? In other words, you guys, were we sold a lie? Was the price decline, again, I know it's many things, Melody, but was the price decline really just from the elites? And remember, you guys, and I'm asking this question as someone that has lost everything. I lost my family as well during that time. I lost everything. I had a foreclosure. I watched our government, the Federal Reserve, bail out the bank that had my home loan, and then they took my house. So I think this is a fair question. I'm trying to figure things out here, Melody. Definitely appreciate your time. I think where I really want to start is I want to start with the beginning. I want people to really understand who you are. I really want people to understand, why should we trust you? What's your experience that you feel like, you know, people should be listening to? Now, I already know those answers, Melody, but I want to start from the beginning. Can you tell us what your background is? And can you take us through TARP, the companies that you worked with, threatening the Fed with bankruptcy? Can you take us all the way to Berkshire Hathaway, okay, right before AUS and Fannie Mae and Freddie Mac, but can you take us all the way there? Tell us about your journey, Melody Wright.
Sure. And I've talked about this before, Travis. So, I always think people are going to get bored when I tell this story, but clearly that was not the case when I wrote this Substack, because the feedback I've gotten has been very powerful. So I'll tell it again, I guess. I fell into mortgage in 2006, September of 2006. My anniversary would be this month, as a project analyst at a mortgage company. And I remember very clearly sitting down for the interview, and the guy asked me, "What made you want to come to work for a mortgage company?" And I just said, "This is a mortgage company?" I had no idea. And honestly, I knew better. That's not something I'd normally do in an interview, but I think I wasn't quite that interested in that job. Anyway, I got it, and I got it. I was in a corporate financial planning and analysis group, and your corporate FP&A groups are always kind of the right hand to your executive, because essentially anything you're going to do, are you going to buy something, are you going to sell something, you really need that FP&A group to kind of model it out, help you understand what's going on in the business. And in October, I went to this crazy party where, they'd rented out a huge space in downtown Minneapolis. Balloons were falling from the ceiling. There was a life-size Lego model of a home that people were walking around, and people were just kind of nuts. The people on the stage were just going crazy. And I remember turning to my new colleague and asking, "Is this Enron?" I really asked that question because that was the most, kind of recent memory of people just acting completely nuts.
Melody?
Yeah.
I knew you were going to do this. I hate to interrupt you. The viewers absolutely hate it. They want you to sing, but she forgot to mention, and I should have mentioned this, to everyone. Melody also studied research and journalism. She is a college-educated expert when it comes to research, journalism, International Monetary Fund. She's worked with the Wall Street Journal. She's ran a political campaign with a senator.
Not
Melody
his
Wright?
campaign. I did not run his campaign, but I did help with many campaigns and writing and things like that. Mm-hmm.
Sorry for interrupting you.
No, yeah. Quickly, I'll just say I started out as an academic, but I never really had enough money to not work full time. And so I worked several jobs in my undergrad. But then when I went to NYU, I got full-time jobs. And my first one was at the Wall Street Journal, Dow Jones. And I started on the executive floor. And luckily, I knew how to use Microsoft products. And when I got to Dow Jones, no one had ever used those before. They had a legacy system called Dow Core. And so I kind of started as a temp on the executive floor, and then, stayed there full time for several years. And I learned a ton. I can remember very clearly Paul Steiger, who was the managing editor at the time, getting hats that said Dow 10,000. This was the run up of the 2000, bubble. And everybody would wear those hats because everybody was so excited that the Dow was reaching those levels. Similar to today, except it was Dow 40,000. If we keep going, it'll be Dow 45,000. So anyway, was around kind of that mania early on in my career and could witness it.
I have a quick question. I did think
Sure.
of something that came up, and y'all, just to reiterate what she's saying, she has a very rare and unique behind the scenes perspective on what's going on with mortgages. And her journey starts out literally, guys, right before total annihilation, total collapse. And that's what she's taking you through. But I wanted to pause a second.
And this is the important part. The government was not going to provide any form of assistance.
The other Wall Street banks said they were not about to rescue Lehman, but Paulson was standing firm. There would be no bailout.
The stock market dropped by hundreds of points right from the open.
Lehman collapses, and there's shockwaves to the world financial system.
Working for the Wall Street Journal, an executive assistant for a politician. Melody, be honest, I was victim of this. Did you get hooked to that lifestyle, to that rat race, to that debt prison? Did you get hooked to that?
Yeah, I think I didn't really have a choice because I had education loans, Travis. And so, but absolutely. I think that, as we know, there's no financial education in the US. And I had no idea what I was doing. And, you go to college, the first thing they do is shove a credit card in your hand. You get the application without asking for it in the mail. You get 10 of them. And I mean, they get you started early when you sign up for those loans. You typically sign up for your first credit card. And so 100%, I mean, I had no idea what I was doing. And, I always felt a little bit other from that lifestyle, to be honest, Travis. I mean, I was around the ultra rich, right? And I was living in a tiny little apartment on St. Mark's Place, less than, probably my bedroom was probably less than 300 square feet. It was like a loft and I had a computer under my loft. It was tiny.
This was in New York?
New York City, yeah. And so
New York City.
I kind of always kept just kind of, I was always suspicious of that kind of wealth. And I also just saw the way they lived. And I knew I did not want to live that way. When you are that wealthy, it's very difficult to trust anyone. And there was reason. People were always sort of betraying you, telling your secrets, selling your secrets, essentially. And so living in that world, working in that world, it really gave me an appreciation for not wanting to have that kind of life. But I still spent like an idiot. In New York City, you don't cook, you go out to eat every night, and even with student loans, I had to have this really high paying job. And when I left New York City, I took a break from the rat race, Travis, because it had consumed me. I remember getting calls in the middle of the night at 1, 2 a.m. from whoever I was working for, needing something. And I never had a life. And so I went off to Taiwan and taught English for 6 months and tried to kind of reorient myself.
Your heart, it sounds like, I think maybe you have to give back.
I have this, I always, in many ways, whatever I do, I just put 100% into it. And so this is something you and I talk about all the time, that we have to be careful and not burn ourselves out with what we're doing now, because we have burned ourselves out previously in those types of jobs and kind of giving our all to things that perhaps we should not have been giving our all to.
I get it. I mean, it's hard not to come, to that line of burnout, especially when we've been robbed of our futures, the inflation. But Melody, I mean, I want to tell the viewers, so you're around these people, you're around these bankers, you get started as an analyst, highly educated, a little bit naive, maybe not understanding the full level and depth of the corruption and the fraud yet. I want you to take the viewers to TARP, okay? And I want you to bring us to when you guys, the company you're working for, they were about to go bankrupt. They were about to publicly announce bankruptcy. But I believe, and I don't want to speak for you, seconds before the company you're working for was going to publicly announce bankruptcy, the government bailed them out.
Some history. So the company that I worked for actually was a subsidiary of General Motors. And General Motors was running into trouble in 2006. We had been kind of the crown jewel of a GM. We'd made them a lot of money, but they needed some cash. And so they turned around, looked for a buyer for a majority owner for our company. And that happened to be Cerberus, which is private equity. And they came in, they completed that purchase for I think it was like $14 billion. It was a lot of money. But very quickly, they realized that the party, like that party I was at in October 2006, was actually over, and they wanted a purchase price adjustment. And so one of the reasons that I became so knowledgeable about this space is that I basically went out and learned this for them so I could come back and report to them, about what is the business, how does it make money, and then what is it worth? And so, like you say, Travis, in doing that, we started our write-downs early. We started them earlier than Chase and others. And there was all this trouble brewing. And in fact, we were number one on the mortgage implodometer page as the most likely candidate to go bankruptcy. And we held off for a very long time. But essentially what happened is, we were sitting in the fall of 2008 in earnings, getting ready to do earnings. So I was in New York in the GM building. And Travis, you and I have a picture of me in front of the GM building from when we went to New York. And I was there and we were told not to talk to anyone. We were sitting in this tiny little room, like this temporary office. I was there with the investor relations team. And basically, the reason why we weren't supposed to talk to anybody is the plan was there was a high likelihood we would announce the ResCap bankruptcy that next day in earnings, or we wouldn't. We really didn't know, but they didn't want anybody talking to us. So we're sitting in that room and I hear, and this is on the executive floor, this is the floor where the CEO is, all of the executives in the GM building. And I hear outside someone running down the hall, like just boom, 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 running, screaming, get X on the phone right now. And I believe I was really the only person that had that person's phone number, but that's another story. But it was a CFO of a very small bank that we had in Utah. And this was the beginning of the plans of us becoming a bank holding company. You now know this bank as Ally, but back then it was GMAC. And that was the beginning. And we got our TARP funds. And so it wasn't seconds, to your point, but it was, hours before we were going to announce. We decided that we would not be announcing our bankruptcy. And sure enough, we got our TARP funds.
Recently, Wall Street companies that had received TARP financing, TARP, of course, being the Troubled Asset Relief Program, had just paid out $18 billion in bonuses. Once that news became public, everybody in government spoke out against the bonuses. Everybody lined up in front of the television cameras to say the bonuses were wrong. Everybody said that it was outrageous and unacceptable for these Wall Street bonuses to have been paid out when these institutions were receiving billions and billions of dollars.
Let me make sure everyone's on the same page. So what Melody is discussing right now is banks and non-banks. They have a portfolio which represents a whole bunch of money, a whole bunch of mortgages. This is very important, okay? So she's witnessing, and and I'm going to say this carefully. Hopefully it's not painful. I don't want to be hurtful, Melody, but when I take into account what you said about being a useful idiot, I still am a useful idiot because I'm not fully awake yet. I'm starting to learn stuff every single day. Would you say that you are a pioneer at the and on the forefront of fraud configuration?
Was I on the forefront of that? I think now I have to understand that I was, but that certainly was not how I felt, Travis. We thought we were saving the world. We were working, 20 hours a day to save the jobs of the people at our company. It felt like an important mission. But what I remember more than anything is, what I think now more than anything is that we were really, they were using that. They were using our youthful ignorance to really, and who is they? Sometimes, is it ignorance? Is it ineptitude? Is it on purpose? But I think as I look back on this now, I understand that probably most of the folks like me had no idea. We had no idea the scale of what was happening, but there were probably a few people that did, that we interacted with. And so at the time, I can say this, myself and our colleagues, we thought we were doing the right thing. We thought we were fighting for our colleagues, fighting to keep jobs. And in reality, that is not at all what actually ended up happening. And we, in essence, enriched a very few number of people, through the efforts, through what we did. And then you could see it. We could go to the feeding frenzy that became our auction now and Berkshire Hathaway, because Essentially this platform, we were top 5 originator and servicer. And we truly, this is the other thing I've come to understand, as we were truly a non-bank. Of course we had this tiny bank, but we were the only non-bank of the big 5, which gives me a completely different perspective of what's to come, because now the majority of your lending is done by the non-banks and not the banks. And so we were the only one of the last cycle. The other big 4 were your banks like Citi, Bank of America, Wells Fargo, and Chase.
And Melody, I want to make sure that the viewers understand what a non-bank is. A non-bank is a bank that ain't got no money. A non-bank is just a middleman that is sucking the money into their own pockets in the form of fees and commission, I think it's fair to say. And I think that you and I would both argue that it's a complete waste. And when I say they, Melody, when I say they, it's them that I'm talking about, those elites, those people that are controlling the mechanisms like a puppet master of these non-banks. They got no capital. The capital is it's not even real. So
it's just borrowings. It's borrowings, Travis. It's just debt. I mean, that's
right.
And then the minute that so when you take out those huge loans, there are certain covenants that you have to keep, like your tangible net worth has to be a certain amount. And if you trigger those covenants, they can pull your loan in, which is what happened to us. And we lost a lot of our funding because we didn't have deposits like they do at the banks, because that's how the banks can get through things like this. They can use your deposits to lend out money, whereas we were just borrowing money.
Right. I mean, it is a huge, huge issue. And again, the question is was that really the response, why we had price decline? Because that was so much credit tightening. When all the banks are going out of business, especially those non-banks that take the majority of those risks are going out of business, then they shut the doors to the bank. But I want the viewers to understand as well the points that you're trying to make. And then I want to go to Berkshire Hathaway, but we're talking about an extremely fragile banking system. Took me a long time to understand this. The banking system has been broken for a long time. The banking system is like the Texas power grid. All right, it's being held together by duct tape, fraud, corruption. And these non-banks, number 5 servicer, meaning they're servicing, they're collecting the money on all of these mortgages, number 5 in the nation. It was so big and they understood their power so well and understood the Fed so well. And that was just back then. Right now, it's way worse. So well that they actually threatened the Fed. If you don't bail us out, we're going to go bankrupt. So you better bail us out. Or to threaten something like that, Melly, I can't even.
Not exactly, Travis.
Okay, can you go into okay, you guys are putting all this effort in. You are a pioneer. You're trying to help all these people. You're trying to keep this servicer together. But eventually, even with the continuous bailout, it still went under. Can you take us to the point, and can you explain how the bailout just kicked the can down the road?
Yeah, so we got the TARP funds, but I think a lot of those funds were probably used in our rebranding campaign to Ally because the servicing operation was being somewhat starved. And so what you're referring to is something I write about. The consent order was about the servicers. What they were being accused of was incorrectly foreclosing on someone. Now, we did this huge review, all of our cases, and found that we had not incorrectly foreclosed on anyone. And at the time, all of the big banks found the same thing. But were they doing bad things? They were robo-signing affidavits, which you cannot do that. It's illegal. And so we were put under something called the consent order. And this is when a lot of your top 5 had to put all of their foreclosures on hold, which is one of your points about the fact that the foreclosures didn't necessarily precipitate the price declines. It was really more around the consumer stress. But essentially, there was a civil money penalty related to that. Every time you see a bank get in trouble, there's always some penalty. But my CEO was from Bear. He was very aggressive. And basically what he said to the Fed, and because we would sit on these daily phone calls where they essentially made us break contract law. That's what happened when we did the first loan modification, is you were breaking contracts, which had significant impact on those securitizations where they bundle up the mortgages and things like that. And so we'd have to sit on the phone with the Fed every day talking to them. And guys, these people don't know anything about finance, economics, just the way the world works. And so ultimately, he did threaten them like, hey, you know what? We'll just go bankrupt instead of paying your fine unless you give us a lower fine. So I think that's what you're referring to. But there was so much going on. And as I said, so much interest in our platform, in our loans, because we were so large. And a lot of the non-banks looked at this as their opportunity to get a really big piece of the pie. And Warren Buffett obviously saw the value. You know, we had been engaged with them in due diligence for a very long time. You know, I think at one point they were actually thinking about buying the platform. But essentially, Berkshire Hathaway ended up buying a big portfolio of our loans that I would then find later after I left my company. But, you know, essentially, too, I think you probably want to talk about the fact. So what happened in this, when you go into an auction like this, there's something called a stalking horse bidder. And we had one that was actually NationStar or Mr. Cooper. And we did due diligence with them for months because they really needed our technology, our servicing platform, because they didn't have one. They had an old one. But essentially, we did all this due diligence, but then this company, Aquin, did some and anybody in this industry knows the name Aquin. It's probably one of the worst. It's really like a 4-letter word. But they basically just kind of did some math. They took their portfolio, which was very small, private, and were like, oh, we can offer this much because we'll offshore everything. What they didn't really realize is the politics that are around agency servicing, and that's, Fannie Mae, Freddie Mac, the politics around FHA, VA. So they came in, they upset the auction, they completely outbid NationStar. And, you know, all we knew about them at the time is that they offshored, it was terrible customer service, as well as they didn't pay their vendors. This is what we heard from everybody. And so none of us wanted them to win, but they came in. And that year, the guy that was the head of that, Bill Irby, was featured on the front page of Forbes. Not a year later, so the feature was all about how he was so smart. He'd amassed this fortune, blah, blah, blah. A year later was, how did he lose that fortune? Which we could have all told him he was going to have a lot more. We tried to tell them, honestly, over and over, that this game was very tricky, and they didn't listen. And, you know, they kind of imploded.
And so they lost, and, you know, the birth perhaps of the next round of acquisitions of loan portfolios. That's that toxic debt, if you will. And so, you know, really what I'm trying to paint the picture of is Melody was the pioneer of interpreting the law on how to help people. But a lot of those elites, from my interpretation, a lot of those elites just used and abused her and just used her good heart and comprehensions and education to just profit them, just a handful of people. And so Melody actually traveled the nation. This was towards the end. She traveled the nation going several different states. Props to you, Melody. Holy smokes, I couldn't do it. I'd die right now. And she's, you know, one of her jobs during these acquisitions and during, you know, this time, she was meeting with law firms. She was meeting with attorneys, and she was explaining to the attorneys loan relief, because she was a pioneer. And I say all of that, y'all, because she has the experience. That's what I'm trying to explain. And so when she talks, at least I believe Melody, I think we should listen. And so anyways, you have all these acquisitions. No one understands what's going on. You're interpreting, you know, you're one person interpreting what appears the whole industry. And so now they bail out Fannie Mae, they bail out Freddie Mac, and then this whole repurchase program settlement begins. And repurchase basically means usually non-bank, a lot of non-banks, banks, they lend and they commit fraud. I'm just going to say they commit fraud. And so it's a repurchase. There's huge fines. Can you now take us to, you know, past these acquisitions, and during that time, explain the power of Fannie Mae and Freddie Mac and how they birthed repurchases, which is they're buying fraud. They're not changing the guidelines, or just buying fraud, and how that also birthed AUS, which again, to the viewers, I always get knocked on this, Melody. AUS stands for Automated Underwriting System, that allows banks and non-banks to approve loans with limited upfront due diligence and effort. It's literally a computer program. You input data, you hit a couple buttons, and it issues you out an approval. Melody, the mic is yours, my friend.
Yeah, so I think repurchase originally was about, finding errors. So when you originate a loan, you make that loan, you close it, you turn around, you sell it to Fannie Mae, Freddie Mac. You might sell it into a Ginnie Mae securitization. But if you didn't do something right, this is written in the contract, then that could trigger a repurchase. And one of the reasons could be fraud, Travis. But honestly, there are a host of reasons they can turn around to you to make you repurchase. And so, and they were off. I mean, a lot of these things weren't controllable. But just responding to them could take so much work. So I had an entire room of writers that wrote chronologies. What's a chronology? Basically, it's everything that happened in a default case, because they were very much about the timelines. And this is for something a little bit differently called compensatory fees, that if you don't follow certain timelines, they can charge you. At the same time, for instance, the Fed is saying you can't foreclose. Fannie Mae is saying you have to foreclose. Like, this is the job of a servicer. You sit in the middle of all these crazy things. But the repurchases got out of hand. They got crazy. They were coming back for all kinds of things, crossing a T, dotting an I. And again, I'm exaggerating, but it was essentially that. We decided to try and settle our origination repurchases with them, give them a lump sum to say, let's be done with this nonsense. So we did that. What happened? They turned around, they came up with a new type of repurchase called a servicing repurchase, which a lot of those happen to be title issues at time of origination. But the point I think you're trying to make, and what I'm trying to, is that, they will figure out any way to squeeze those originators and put back all the risk on them. And to us, it looked as if any loan that went into default. So the idea is it's supposed to be kind of a sample when you're doing a QC audit or quality control audit, and you're supposed to be doing a sample. But what we could tell is every single loan that went into default, they would check to see, did you dot that I? Because they didn't want the expense. So they will always figure out a way to push it back to the originators.
It is so intriguing to the viewers hearing Melody talk about this, because my experience is as an originator. And so when she says QC reviews, she's making sure loan officers and underwriters are doing their job, which means they're reviewing documentation to prove that a borrower can afford a mortgage and not go into foreclosure. And so, loan officers and underwriters are supposed to do that due diligence. She's coming in, Melody's coming in, finding, whoa. Just like Alan Greenspan said when he was in Congress, they asked him, what did you do wrong, Alan Greenspan? Well, I underestimated corruption. I thought people were, good people still. They weren't. But let me ask Melody, is it fair to say, and you help me come to these conclusions and concepts, is Fannie Mae and Freddie Mac just the long arm of the Fed?
Travis, it's very difficult to say. These regulatory or these government agencies, sorry, Travis, I don't know that I can answer that question. I don't think, they're very large, these organizations, and there's a lot of vested interests, and you never quite know exactly why they're doing what they're doing. But I think that they're probably, we know about these bureaucrats that kind of outlive presidents that sit within these agencies. So I do think sometimes there is an agenda, put it that way.
I say that because it seems like Fannie Mae and Freddie Mac is just the Fed. And I also say that because, looking back at history and then what we found out what happened in 2018. So 2018, the CFPB, Consumer Financial Protection Bureau, found that in during 2018 that 16% of the loans, total loans that were generated through automated underwriting, were in violation of QM, meaning that the debt to income ratio exceed the allowable thresholds. And the first thing I thought, well, why would you even allow lenders to even exceed that threshold? But the crazy thing is instead of them getting penalized, like you would think, and shot across the bow, instead of that, Melody, they just changed the guidelines so they didn't have to pay fines. Again, putting the consumer in harm's way. And that's why I say, I mean, it seems like Fannie Mae and Freddie Mac are just long arm of the law. And look, and then again, when I was reading your Substack, I was like, man, there was a settlement back during the GFC where, again, everyone's going through these books, you know, everyone's going through these books. They're finding fraud, or violation, compliance. Huge, massive problem. And so Fannie and Freddie settle for, I believe you said 462 million. To me, that's the birth. That's the birth of when we lost control completely. And that's, again, when AUS was born. Everyone's trying to stay alive. You know, oh my gosh, don't send me to prison. So here's AUS. And AUS, do you think that automated underwriting, I used to think it takes the human element of error out of the equation, Melody, but then I just realized that most humans that are loan officers are horrible loan officers. So now I'm thinking, if we can assume that we properly train our loan officers and educate our loan officers and hold our loan officers accountable, isn't AUS just actually, you know, harming due diligence? Wouldn't it be better that we required underwriters to manually, it's called manually underwrite files? And I say this last thing because those automated underwriting systems, they're only as accurate as the people that are inputting the data.
And you can learn how to play them. I mean, that's what everybody figured out is how do you play the AUS? How can you just kind of rejigger this and or do that little, you know, income stream or whatever? How can I make the changes to get approved? It's like any game. You're going to learn how to play it. You're going to learn how to win it. And I think that's exactly what happened with AUS. Why that million loans probably occurred is because people figured out how to work the system. They always do. And so, you know, I think this is a big misunderstanding is everybody's turning around. I'm still hearing it on social media today. It's like the banks. And it's like, no, in actuality, what's behind this is a government sponsored enterprise. And I have come to the conclusion, like you, Travis, that I really do believe credit can't be automated. That to truly make a decision about credit, you do have to sit down, talk to that person, really understand, because this is what happens. And people at scale figured out how to play the system, and to them, they got that approval back. And in actuality, if you don't make a loan, let's say, because I've talked to some of my clients about this. Let's say they don't want to rely on AUS, right? They want to do their own manual underwriting and decide not to originate a loan. They could get in trouble for doing that. I mean, that's redlining. They could call it any number of things. And you see how much effort is actually put into non-discrimination in the mortgage industry. But in reality, I think a lot of that is covering up or taking away the agency from these originators and lenders, and they refuse to bear responsibility. You know, they didn't bear any responsibility the last time. I think one of the things that really troubled me about all of the consent order and the AG settlement, it was like, well, what about the originators? Yes, we were both, but it was the servicers who were dealing with this nightmare because of what happened during origination. That really got penalized and got into trouble. And when in reality, it should have been about the fraud that did occur at time of origination.
Yeah, and I see that same thing, and I have to be very cautious saying this, but I see them, like these agencies, use, you know, racism to change law, almost use it to manipulate the lie, to carry on the lie. Now, don't get me wrong. If someone is treated with racism, that person that is with that hate crime should be locked up and sent to prison and learn the true value of life, which is to love and to serve. And so stay in prison until you realize you should love people. So I won't go there, but the thing that is so crazy to me, you would figure with as many fees and middlemen that we have, that we can count on the due diligence. But the fact is, Melody, we can't. And we see similar things that have happened in the past happening now. In essence, these non-banks are killing America. I mean, they have less regulation. And so that's why I keep asking, and I keep asking myself, maybe that price decline, and I'm specifying price decline. I know it took like 6, 7, 8 years for the housing market to rebound, but the strongest times of price decline was during 2008 and 2009. And foreclosure inventory didn't even really start until 2010. And so I know late payments and purchasing power, all of that matters. But when I overlay the price decline with the distress of the banks, it's like it freaking matches, man. And it's like, maybe they lied to us. Maybe they just said it's about foreclosures because we were going through that pain, but they needed to access the money to bail out their buddies. I don't know anymore, Melody. I feel like everyone's lying to me. So I want to move on. I want you to comment on that, and then I want to move on to the current state of the market. But do you see why I'm asking that question?
I see why you're asking. I think it's incredibly complicated. And I think, at the time, for sure, I can look back now and what we knew, absolutely. And what I could, because this is kind of personal to me, Travis, because I sacrificed a huge part of my life during all of this, and my health to a big degree. Is what I've now realized that none of those programs helped the borrowers. Typically, none of what the Fed did helped the borrowers. Like, one thing, they wouldn't let us, if anybody called in and asked for a loan modification, you would have to re-review them, even if nothing changed. Now, people caught on to that. Well, which people caught on to that? Well, your strategic defaulters. Typically, those are the people that actually do understand finance. Those are typically your top 20%, top 10%. But your regular forgotten American would never even think about calling and saying, give me a loan modification numerous times just to put their foreclosure on hold. Your forgotten American wouldn't think about filing bankruptcy just to put their foreclosure on hold. And in reality, a lot of those loan modifications and a lot of the actions by the Fed actually helped the people that didn't really need help. I remember very clearly my CEO telling me a story about his buddy down at the shore who was living in a, like multiple $1 million home, I think a $9 million home. And he called the CEO and said, wait, do I have to pay my mortgage now? I don't want to pay it. Can you tell me how not to pay it? Those are the people that got helped. It was not you, Travis. It was not the regular Americans. It was, again, people that understood how to work the system or that had political capital. And so it will be, and it has been the same way. If you look at SVB, who really benefited from that bank bailout? Wasn't us. It was not us. It was a bunch of millionaires that should have never had all their money in one bank. Ridiculous, when the FDIC only at that time only insured $250,000. The SVB should, and probably I'm sure I'll get some hate, but I don't see any reason why that bank was saved. And again, it didn't help regular Americans. It helped a handful of very wealthy individuals, including foreign wealthy individuals.
Melody, I think it's so important to talk about this and to really kind of go down that thought process, because if the reality is it was more about speculation and these lenders tightening up credit, and being that fast forward to today, the housing market's so bifurcated, meaning that today versus the GFC, there are more people so far, right, comparably, that have equity. And there are some people that have a 3% rate and some people that have an 8% rate. And so it's important to understand that, yes, it is bifurcated, but the math isn't there. A lot of these markets are overheated, but it all goes back, it all ties back into non-banks. And those non-banks are really leaning on the current state of households. And that's why these things, it's slow, and then all of a sudden it all comes falling down. And so Melody, can we quickly go through some of your data? I'll put up on the screen and hopefully you can see that okay, but can you walk us through some of the data that you shared in your Substack, starting with the delinquency rate on single family residential mortgages booked in domestic offices, all commercial banks?
Yeah, so this is the Fred schedule of the delinquency at the banks. And you can see that in Q3 2006, I think we're at 1.74 delinquency, something like that. And you know, what I wanted everyone to understand is we are essentially where we are today. So Q3 2006, when I started at ResCap, we have about the same delinquency as we did then, looking at the Fred schedule. Now, why, and we've talked about this on your show, Travis, why this Fred schedule can't tell you the whole picture is it is just commercial banks. And we know that the majority of lending happens at the non-banks. And so what I'm trying to show is that basically it doesn't matter that delinquency is low right now. Based on what I'm seeing in my client books, borrowers and consumers are under stress. And we saw a really big uptick in June. The push and pull of delinquency because of these massive programs, people are going to fall out of a program, fall into a program. Parents will help. Friends will help. They'll go in and out of delinquency, but we are at the point now where it's becoming sticky. And this is very reminiscent, in my opinion, of exactly where we were in Q3 of 2006.
I'll say it, Melody, and this data is manipulated. We know for sure that they've constantly changed stuff on us. They've constantly manipulated the narrative. So this is BS, but I think it is very intriguing that you pointed out we're literally at the same delinquency rate as we were right before we entered the great financial crisis. I mean, and look at a skyrocket, and that skyrocketing represents what? It represents that you cannot trust the market. It represents that there is a narrative and that the market is always ahead of you if you keep your head in the sand. And so let me move on to the next one, Melody. I'm sorry. This one's good. I really like this one because to me, this takes out, a lot more of people's opinion, because here we can ask who's going behind on their mortgage. When did you purchase your house? How are you doing? And this data clearly shows that the people that purchased at the peak, and I know that was when we had the highest volume of transactions, but the people that purchased at the peak, it's a fact that they have the highest rate of current delinquencies. Will you go over this data, please, Melody?
Yeah, and just to be clear to everybody, so this isn't showing their delinquency rate. This is showing the percentage that vintage year is of overall the delinquent loans. And so the number in 21 is much larger than any other cohort. And so when you think about vintage, just think about that's the year it originated. And so we should not be seeing that, Travis, not with the GFC style intervention we've already had from the government. But importantly, and this was on another schedule, we don't have to bring it up. 2022 does have the highest delinquency rate. And again, that should not be happening either. Anytime you see newer originations going delinquent, you know that there is an issue in the system.
Well, yeah, we can clearly see that there is the problem that's brewing, and we clearly know from what's going on right now and what's going on in past, and even, I won't even go into ancient civilization, but my God, you can't trust the people in charge. And that sucks. That really sucks. But I'll move on to the next data set. And again, just to reiterate, this is like how many pieces of pie, right? This represents pieces of pie. This whole thing is the total pie, total loans. Those property taxes, homeowners insurance are brutal. A lot of people didn't prepare for that. But here's the delinquency for the first 7 months by vintage year. Melody, can you talk about this, please?
Yeah, I think this schedule is actually really important because you can see 2021 in its first 7 months did just fine, right? There was no issues. And I think that's because PPP money was floating around, the ERC tax credits, you still maybe had some stimulus in your bank account. And so it did fine. This is the first 7 months. But since then, you can tell that they have not been doing fine, meaning that these loans likely should never have been, or a large portion of them should not have been originated. And these loans that are delinquent definitely should not have been originated. And we will start to see more repurchase requests for early payoffs, early payment delinquencies, and things like that.
That really represents a bifurcation as well. It really shows that gap of when it got spiraled out of control. And I just want to reassure people that are down on themselves, like, oh, I missed out. Or if anyone's bullying you, oh, you missed out on the best time to buy in history. No, it wasn't. That was one of the worst times to buy, because in order to get those 2-3% interest rates, you had to literally forfeit what you wanted in a house. Don't forget the bidding wars, the lack of inventory. People were waiving contingencies. It was absurd. And so don't get down on yourself. We have it in the data now. Now we're seeing what happened to people that made a decision to purchase a house. And now, honestly, and this is bad, but I may be able to buy the house that I wanted via foreclosure. That's messed up. I don't want to buy my dream home from someone else's turmoil. So the more people that pay attention, the sooner that we can correct and stop the system. Here's another one, Melody. This is overall delinquency percentage by vintage year. What can this tell us about what's going on today behind the scenes?
Tells us, you look at 2022, it just kind of tells me everything I need to know, Travis. Like, that we really, it was not a good time to buy. It was a terrible, terrible time to buy if you were going to take out leverage, because as these folks were getting into these loans, they didn't realize their property taxes were skyrocketing. They didn't realize their insurance was doubling, tripling. And in some cases, if you're in California and Florida, you don't have any coverage at all. Or you have to use, in California, you have to use the fire state. It's called the state fair plan. And so essentially you have government subsidizing insurance because people can't afford it. And then in Florida, you have Citizens, which is the government-backed insurer of last resort there. And so you can argue as well that another thing that's propping up home prices are the facts that we do have these subsidized insurance programs. And so it's as if all of the incentives have gotten completely messed up. And, the speculation, someone had described California to me, especially in some of those more expensive locations, as people were just trading cards. It was like they weren't, these aren't homes that people were living in. They were investments that people were trading. And a lot of that was being done by foreign owners. And so I think what that chart showed to me, Travis, is, there are a lot of things that were going very wrong during 2022 in the housing market.
Let's end us out, Melody, let's take a look at the 90-day delinquencies. Let me throw that on the screen real quick right here. Let me get my face out of the way. Okay, there. That way we can see the bottom here. And I just, before I let you go here, I just wanted for the viewers, this column right here that says reduction of income, I think is especially important, because this is explaining why the delinquencies, 90-day delinquencies, your purchasing power is dead for years. I mean, people are like, yeah, no, the government's going to bail me out. But if the government bails you out, your purchasing power is dead in the water for maybe even a decade. It just depends what you do after, you lose everything. So Melody, can you please explain, what we're looking at here?
Yeah, this is one of the most important schedules, I think, that we can look at this cycle. It tells us so much. And this is found in the HUD Loan Performance Report. And what this schedule is the reason for delinquency. So when you call into your servicer, they'll say, why are you behind? And you give a reason for default. And that gets coded into a system, and you need those reasons. And so what this is showing us is that people are falling behind because of unemployment, reduction in income. But the other thing that this schedule is very important to look at is thinking about fraud, thinking about investor participation, thinking about that Philly Fed paper that talked about non-owner occupancy fraud. And when you are investing, when there is investment in homes like this, that 30% of them are likely fraud. So that reason for default for no contact, what does this mean? It means your servicer is trying to reach out to you and you're not responding. I mean, this thing just, month over month, this jump is huge. And this is what happens. Investors walk away. They don't have any skin in the game. They will just hand the keys back. They'll never contact you again. You'll never see or hear from them. And the servicer will then spend years likely litigating to take back ownership of that property. But looking at that no contact tells us that, kind of the stripper in The Big Short is kind of saying, oh no, I can't really afford all these loans. I don't want to talk to anybody. I'm done.
Oh my gosh. I didn't realize that until we just started this segment of this video. And that's why I was getting excited. I was like, oh my gosh, because I was looking at the bottom 2024 Q4 and I was like, just trying to see if there's any things that were irregular and obviously reduction of income. But when I got over here to no contact, I was like, oh my gosh, no contact has a delinquency rate of 17.8%. And then I went to the previous quarters and I'm like, there's not even double digits on here. I mean, it's smoking that. And then I was thinking, Melody, I was like, I wonder if it's those sub 2 guys, right? I wonder if like the no contact, because that doesn't make sense, that jump like that. So I bet you it's those.
And I don't think that's the delinquency rate. I think that's the percentage of 90 plus that is delinquent.
The reason, yes.
And the reason for default. Yeah, I just wanted, so. Okay.
Yeah, that's very interesting. It seems like the no contact has been that way for a while. And look at how low it got, in 2022, Q3 and Q4. I bet you if we go back to Q2 and 3 of 2020, I bet you that's when that sub 2 had the biggest growth. Look at that. I mean, there's no 1.3, 1.4. I mean, there's no, I'm surprised they even have that as a category. It's so low. Same thing with death and illness. And look at the other thing, Melody. Holy smokes, what? I don't understand that. Death and illness skyrocketing as well. This is revealing.
Yeah. And I think, death and illness, we know we had COVID, but also, something unfortunately that I saw during the default crisis is this really takes a toll on people's health. I mean, this is really stressful going through a foreclosure. Getting those notices, getting those phone calls, thinking you're going to be thrown out of your house. I think it's really interesting that Census Pulse survey that both you and I look at, Travis, when they ask, okay, are you current on your mortgage? And the amount of people that say no is now up to 6 million. And there's also a question on there, are you afraid of being foreclosed on the next 30 days? And so many people respond yes. And I think, why would they respond yes? You can't even refer anyone to foreclosure for 120 days. And then on top of that, basically they're going to do everything in their power to keep you from going to foreclosure. So the fact is that that just tells you how stressful this is for these homeowners that are sitting, that have this delinquency.
I hope we provided to the viewers a few things. I hope that they could answer for themselves. Is the Federal Reserve good? Is Fannie Mae and Freddie Mac just the long arm of the Fed? Are they just really supporting fraud? Because again, we didn't cover this too much. When we have reports from the CFPB saying that 16% of the total loans in 2018 were in violation of qualified mortgage debt to income ratio, and then their action, instead of fining them and warning them, is to change the law and allow it to continue to happen, it makes me feel like the price decline was always a result of the speculation. It was always a result of the elites. It was a little bit of the foreclosure and consumer purchasing power, but this runs deep. And so, Melody, let's end here. Let's end maybe, with all your experience, with all the things that you've been through and your overwhelming love for normal people. What kind of hope can we end with? We don't want to end with people being scared and stuff like that. How should people leave this video feeling?
I think they should just be more aware, Travis. That's all we're trying to do is educate. This is a very complicated system that no one understands. And when you make that home purchase, you think you're just buying a home for you to live in for the next, however many years. But in reality, you're buying entrance into a very complicated system where the folks behind it, regardless if they come from the government, might not have your best interest at heart. This is a money game. This is, I think back to Freddie Mac wanting to do that closed-end second program after the devastation that we saw back during the GFC as people's equity got completely destroyed because of price declines. And so for Freddie Mac to come out with a straight face to, kind of talk about this program, just to me, that was it. That was a nail in the coffin, because if they could do that, then they don't care about the consumer at all. All they care about is keeping that engine, that securitization machine going. So, I just think it's so important to be aware of what club you're asking for access to when you buy a home, because they don't really care if you're a member or not.
I think we really need to redefine, currently, I know this for sure, actually, redefine our definition of home ownership, redefine our definition of what success means, what life is about. And I'm not saying rent and be happy. I'm not saying that at all. I'm saying right now in the market and in the economy, the Fed and the elites and the corruption has just spiraled so far out of control. We've been so manipulated that it's okay not to buy right now, especially if you're choosing not to buy. And in the meantime, you're learning about these things. You're empowering yourself. If you don't want to listen to Melody and I, that's okay. I hope. That's the thing. I hope, right? Once you buy, you're done. Right? At least if you're on the sideline, you can still make a decision. When you purchase, you've already made the decision. And so if you want to buy, so be it. Try to do it with some principles. Try to do it with some fundamentals, not emotion, not at all. Use math. And, I think most people that are using math to purchase real estate, we'll see that there's not a lot of math that works. And so in that, it's okay to rent. Find a place in a nice area, that's way cheaper to rent versus own. Love your family, love your life. Melody, I appreciate your time. As always, I will see you on DNN, I'm sure.
Absolutely. Thank you so much, Travis.
Of course. Now, guys, if you're out there investing in real estate, you guys already know, we wish you luck and we hope you win.